In 2020, the world debt surged to an astounding $226 trillion. Can you imagine that? The planet is $226 trillion in debt to itself. How could that even be? Who is the money even owed to? Well, it's not exactly that the entire planet owes money, it's the different countries within that do. And as for who do they owe it to, well, it's complicated. They owe money to themselves and to each other. If that sounds confusing, then don't worry, we're here to help you figure out how it works in today's video. So hold on to your seats, Aluxers, as we explore how global and national debt works. Welcome to Alux. Why does the world owe money? The debt of a country, also known as sovereign debt, is debt accrued by a government in order to finance its continued growth and development. Whether a government will hold true to its debt is determined by credit rating agencies that verify that information. Yes, even countries have credit agencies checking up on them. Other names for sovereign debt are national debt, public debt, or government debt. For the rest of the video, we'll refer to it either as public or national debt. You see, the debt a government holds can be of two kinds: internal or external. The debt is internal when it's owed to lenders within the country, and external when it's issued to foreign lenders or other countries. Furthermore, short-term debt is intended to last about a year or less, while long-term debt lasts about 10 years or more. Countries that are considered to have middle-of-the-road income can borrow from the World Bank or other institutions. And as we mentioned before, countries can also borrow from each other. But how exactly do the governments borrow money, and how can lenders get repaid? Well, through government bonds. Government bonds are debt securities issued by the government when they need more money for their spending, and they can also pay periodic interest called coupon payments. Since these bonds are issued by governments, they're usually considered safe bets as far as investment goes, or at least a low-risk investment option. And when it comes to government bonds, those from the US Treasuries are considered as close to a risk-free investment as you can get. After all, if the US defaulted on its debts, we would all have bigger problems, but we'll get to that in time. A common way to look at the amount of time it'll take for a country to pay off its debt is by looking at its debt to GDP ratio. The higher the percentage of debt versus the GDP is, the more time it'll take to pay off the debt. And not only that, but a country that stays with a debt above its GDP risks defaulting on their obligations, although some countries do manage to survive with really high debt to GDP ratios. One such example is Japan. While any country past 100% is considered not to be in a great situation, countries have gone past it and back down before. Recently, because of the COVID-19 pandemic, a lot of countries' debts exceeded their GDP, but Japan's debt has more than doubled its GDP for years now. They are the only country past 200% ratio that can seemingly survive at such a high debt ratio. I mean, let's just consider the rest of the contenders in 2020. Greece, Sudan, and Venezuela all exceeded 200% during December 2020. Venezuela, in particular, reached a staggering 350%. None of these are currently known for their solid economies, and yet Japan still manages to survive being higher than 250%. How do they do it? Well, they have to keep buying their own debt for the most part. Japan first hit the 200% level back in 2010, so they've been at this point for more than 12 years now. The way Japan finances their debt is by issuing JGBs, or Japanese government bonds, which the central bank of the country purchases in their majority. More than half of all the JGBs are held by the Bank of Japan. Since they own most of their own debt, they can keep the price of the JGB in the debt market stable and the yield on the bonds low. In effect, the central bank is financing the government at almost negative interest rates. And even with this humongous amount of debt, Japan is still considered a fairly safe bet for investors. In fact, Japan is the world's biggest creditor itself, holding more than $3 trillion in assets from foreign currency reserves and direct investments. But they can't keep it up forever, as it could threaten the growth of Japan's economy, an economy that, like the rest of the world, faces a recession after the COVID-19 pandemic. Debt today. According to a report from the fund, the $226 trillion in debt that happened between 2020 and 2021, mainly due to COVID, is the largest one-year surge in global debt since the Second World War. And the global debt ratio to gross domestic product reached an average of 99% worldwide, almost tipping over to more debt than money produced by countries. This rise in debt was more significant than usual in advanced economies, where the debt has risen from 70% of the GDP back in 2007 to around 124% of the GDP. In simple terms, a lot more countries are producing far more debt than they are capital. What's more, the public debt, which accounts for 40% of the global debt, is at its highest point since the mid-1960s. The significant increase in debt was justified by governments as the only recourse to dealing with the pandemic and protecting people's lives, livelihoods, and staving off a wave of bankruptcies. And honestly, that checks out. Let's face it, the pandemic was brutal, but the problem remains that this caused a massive spike in debt, and now balancing that debt becomes, well, a balancing act. In most cases, the government swiftly coordinated with the banks to stave off the worst of the problem by putting interest rates down to make it easier to borrow. But now we have more debt than ever. What happens if we default? A country defaulting on its debt is not a common occurrence, and with good reason. While there's always a risk of defaulting with any type of debt, national debt is safer than most because in some cases, the country can just raise taxes, reduce spending, or print more money. Although each of those cases has its own potential issues. An example of what happens when government debt gets out of control is the crisis that Greece is undergoing. Just as a person who misses payments has a more difficult time securing cheap loans, governments that fail or threaten to default face much higher borrowing rates. Rating organizations such as Moody's, Standard & Poor's, and Fitch are in charge of assessing the creditworthiness of nations throughout the world based on their financial and political prospects. In general, countries with a better credit rating have lower interest rates, resulting in reduced borrowing costs. When a country defaults, it can take years to recover. Argentina, which began missing bond payments in 2001, is a prime example. By 2012, the interest rate on its bonds was still more than 12% higher than the rate on the US Treasuries. If a government defaults even once, it becomes more difficult to borrow in the future, putting low-income countries at particular danger. According to Masoud Ahmed, a former senior executive at the IMF and now president of the Center of Global Development, as of October 18, 24 of the 59 countries classified as low-income developing countries by the IMF were in or on the verge of a debt crisis, representing nearly 40% of the total and more than doubling the number in 2013. The impact of the larger economy, though, is perhaps the most serious fear about a default. Many mortgages and student loans in the United States, for example, are tied to treasury rates. Borrowers would have significantly less discretionary cash to spend on products and services if they faced markedly higher payments as a result of a debt default. And because of the risk of contagion spreading to other economies, nations with strong relations, particularly those that own a large portion of the country's debt, will occasionally step in to prevent an outright default. This occurred in the mid-1990s when the US assisted the bailout of Mexican bonds. Another example happened in the aftermath of the 2008 global financial crisis, when the International Monetary Fund, or IMF, European Union, EU, and the European Central Bank, or ECB, joined together to provide much-needed liquidity and credit stability to Greece. Where some investors perceive turmoil and losses amid a financial crisis, others see it as a great opportunity. These investors feel that sovereign default signals a bottoming out point for government bonds, or something close to it. So the only logical trajectory for these bonds, according to the optimistic investor, is up. A number of so-called vulture funds specialize in exactly this sort of bond purchase. These funds acquire failed government bonds for a fraction of their original value, similar to how a debt collection firm buys personal credit accounts at a cheap cost. Because of the larger economic ramifications of a sovereign default, default, investors usually seek out inexpensive companies in that nation. Investing in defaulting nations is risky, of course, because there's no assurance that a rebound will occur, and the bigger issues that caused the default in the first place may still exist or have yet to be fully resolved. Those who prioritize security in their portfolio should definitely look elsewhere. Recent historical precedents, on the other hand, are positive for the growth-oriented investor. For example, in the aftermath of a bond crisis, equities markets in Russia, Brazil, and Mexico have grown significantly during the last several decades. The idea is to look out for firms that have a competitive edge, as well as a low price-to-earnings ratio that reflects their high-risk level. The world debt continues to grow, and while that's always been the case, the rate over the last few years is a bit alarming. While countries like Japan have managed to survive having a significantly higher debt than GDP, it's usually not sustainable in the long run. As debt piles up, it keeps getting purchased by other countries, like the case with China and the US, and this gives leverage over political negotiations. While things have remained relatively stable for years, they could quickly change if one of these countries decides to make a move on this debt. And before we wrap all of this up, Aluxer, you know that for sticking with us until the end, you get a bonus, so here's today's. If you're interested in looking at the national debt of countries around the world, there's an interesting website you might want to check out. It's called USAToday.org, and it allows you to see a lot of interesting data about US debt and how it increases in real time based on estimates and projections. They also have a world debt clock if you want to check that out, where you can see the difference between the national debt and GDP of 30 countries, including China, Japan, the UK, and Germany. It's a pretty cool and useful tool.